of April. Let's get the briefing underway. And this morning on the front foot, the DAX just moving up above the highest point of yesterday in the futures already this morning. We'll have a bit of a discussion about the reasons why. But first of all, just having a bit of a recap in terms of yesterday's session, because certainly there was quite a lot of question marks about why suddenly did we have this spark of risk-off trade. We were looking very closely at the correlations yesterday in regards to when there was, when typically there is a light economic calendar. What you quite often see is the market participants will look for a kind of guide of direction, and so to kind of ascertain what the sentiment is on the day. And obviously sentiment has been growing in negativity since the end of last week, really, since those Syrian airstrikes, and then the communication that we've had from the geopolitical side between the likes of also Russia, Iran, US, China, and so on and so forth. So one of the things that we did see yesterday was a very strong move in gold prices. I know we've talked about this several times. I've already got that kind of level that we were watching at the time when the price action started to move off that R1 in yesterday's session. It got up to that technically important level. There was a bit of a hesitation around that mark being a previous resistance beginning of April and support post the Syrian strike. When we broke that, again another push higher, and then that previous wick high just acting as a bit of a benchmark now on the way back down. We're only down about $1 this morning, so overall this is marking at the high a new 5-month high for spot gold prices. And so as we come back down, maybe just interested to see when it gets to around that 1273, that previous kind of spike high on the, that would have been the payroll move post the Syrian strike, to see what the market's looking like there. And then obviously pivot might be quite interesting if it gets back down to that point. And then ultimately, again, as we were watching it on the upside, we're watching it back down if we get to that point at 1263 spot 7 again in gold. The other thing that's obviously been moving a lot and was yesterday, and was one of those assets that I was suggesting to keep a very close eye on, was dollar yen. So movement in the yen typically would act as a good barometer of what the market's appetite is for taking on risk, i.e. dollar yen moving lower, yen strength would be a negative for appetite for risk. So risk off trade, the yen broke 110, which is psychologically important, and overnight the Nikkei once again underperforming, with the exporters suffering under the weight of the stronger currency, albeit it's just come off those lows that were seen overnight in the Asia-Pac session. Looking at the US equity market though, one of the most interesting things here was, despite the kind of, well, let's look at the breakdown in prices that we had first of all yesterday. One of the things that you seem to be seeing at the moment is the European morning, irrespective of the data, so whether it's UK inflation, German ZEW, and so on and so forth, the market seems to wait for the US participants to come in. Ultimately, because this story on a macro basis has been so driven by Trump and the Trump trade, now it's about this geopolitical situation, which is very much led by the US as well, is that it's when the US come in that you tend to see the more forceful directional move in the market. And what typically has been happening is that as soon as the opening bell goes, you have a momentary period of volatility followed by some quite aggressive downside price action. Yesterday, obviously breaking through the kind of lows are getting gradually lower, if you like, as the last 7 trading sessions or so have gone by. A break of that, you can see the wick just extending on the downside, likely some stops run just on the back of that. That was the actual airstrike when it happened on that candle. If I just mark it up, that was when stock futures got hit overnight, but then quite forcefully recovered. So we had a brief breach of that before then making an about turn, and it's kind of coming the regular pattern. As soon as Europe closes shop, market starts to recover, and all the way into the Wall Street close we might get a negative finish, but only very minor negative close of about 0.14% in the S&P in the end, after being down a lot more during the session. Now, why the sell-off? Well, there's a couple of things at play, I'd say. No one real headline catalyst. It's more a combination of different factors. Definitely, as we've discussed here yesterday, the airstrike has obviously put in sharp focus the tensions in two geographic kind of hot zones, if you like, one being the Middle East and one being the kind of Syria and Russian situation. That obviously has implications for the likes of Iran, and then in terms of the Korean Peninsula, that has ramifications for the ongoing discussions between China and the US, and also Japan, who are also involved in that East China Sea key area as well. So you kind of got Korea, Syria. We're also coming on the backdrop of Trump having kind of failed to deliver on his mandate on the healthcare bill, or the repeal of Obamacare. We're not really hearing too much or a great deal as yet about the corporate tax reforms. It seems to be just kind of taking a bit of a back seat at the moment. Now this, all emphasis is being put on the politics with Russia. Moving away from that, you've also got Mélenchon in the French election race, who's come out of nowhere to kind of blindside the market a little bit, because him going through would be add complication to what was a fairly clear defined runoff between Macron and Le Pen. And Mélenchon, as we discussed yesterday, is about as radical with his program or his manifesto as Le Pen is. It's just that one's quite extremist left to extremist right, and you're looking at both being Eurosceptic, which would carry negative connotations for market or asset prices, especially European assets. Then the other thing as well that a few people are picking up on is the fact that we're obviously running into a holiday shortened week, and it's a holiday shortened week to follow thereafter, given that all markets, or US and UK, will be closed on Friday. But on Easter Monday, I think the US is open but Europe shut. Either way though, what does get impacted is the liquidity, and if you're a larger size kind of player in the market, it's probably you're lesser inclined, due to that lack of liquidity, to get too involved in the market during this holiday impacted period. So that also exacerbates a lot of the moves that you see around this seasonal part of the year. So that's definitely kind of hopefully explaining a little bit of the weakness that you got. One of the questions I had this morning was, Asia was negative overnight, and so are we going to be negative again this morning in Europe? Well, the charts kind of answer that question for you now in retrospect. Obviously we're moving higher at the moment in the European indices across the board, but it's a valid question, and one that we get quite often on our programs. And the way I'd kind of explain that is, think of the market in terms of it being open 24 hours a day, divided into 3 different continents, one being US, North American markets, one being Europe, which I include UK, and then the final being the Asia Pac markets. And so basically you're going through a cycle before each day then resets and we start afresh. Now, we've just discussed and ascertained that the US is the predominant driver for a macro theme that's driving financial markets at the moment. Therefore, net, that's when the biggest proportion of the market moves occur. Given what's happened, say yesterday, even though equities recovered, obviously it was a lot of, if you were a Chinese investor having not paid any attention, having been asleep, let's say, out of the market, you come in, turn on your terminals. Yes, equities have recovered, but overall there's obviously a lot of you're talking about gold at a 5-month high, you're talking about the Nikkei at a 4-month low, you're talking about US equities looking quite fragile on the downside, only for a late recovery. So these are all on balance negatives. So then that feeds through into the psyche, if you like, of the behavioral pattern that you generally see overnight in Asia. Now, the difference being that although Asia's finished down, when you go into the European Open, actually European participants have already traded the big downtick, because that happened at 2:30 yesterday, and so they've already reacted to it. And so as such, that negativity is pretty much stops at the end of the Asian session, if that makes sense. Now, this isn't always the US that lead the market direction. If, let's say, the Shanghai comp for whatever reason fell 10% overnight, well then the whole game has changed, and now the extremity of the negative from overnight in China would then dictate probably a negative open for European markets. So back in 2016, when China was the real focus, this kind of premise of potential hard landing, it was the Shanghai composite close and the end of the Asian session that defined the entire opening of the European market. At this present point in time, despite inflation numbers, which we had overnight in China, China is not a dominant theme at this present point. It's the US. So it's the US that's leading this kind of getting the wheels in motion of what the sentiment is, and then dictating the overall kind of broader intraday direction. So it's all about kind of, has the market, in terms of its respective geographic area, had the chance to price in, reposition itself for the information on hand. And so with that, Europe up this morning, because we've already acted on the negative move on Wall Street yesterday. The only difference was that Asia hadn't, because they weren't in the market. So irrespective of the fact that their markets were down, it's not having an impact on our markets this morning. Now, looking on obviously quarterly earnings are coming up. I think it's tomorrow when you get the banks reporting, JP Morgan, Citi, Wells Fargo. They'll kind of unofficially kick off the earnings season. But there has actually been a couple of corporate earnings this morning, which are likely also lending a bit of a hand, especially for the likes of the DAX. Can anyone tell me what company fairly large in the DAX reported this morning in the chat? Because if you're trading the DAX, then you should know for sure. You should even know the results. Otherwise, how can you trade the DAX when you don't know the individual constituent news that's come out pre-market? Okay, good. So Daimler reported this morning before the open, and so this is something now as we go into earnings season for any European equity traders. You must be aware if there's any larger market cap earnings coming out. You need to be aware of the performance of that before really placing any trades in the DAX or Eurostoxx, CAC, Courant, whatever the respective index is. If you've got one of the big bellwether heaviest market cap names reporting, that is potentially going to have a carry across into the overall performance of the index at the open. Now if you look at Daimler's results this morning, their first quarter profit almost doubled on rising demand for Mercedes-Benz cars, including the new E-Class sedan, as well as one-time gains, helping the company off to a strong start of the year after reclaiming the luxury car crown last year. So you've had good results for Daimler. Now if I start breaking it down here, I'm just looking at a DAX constituent of all of the major companies within the index, and I've ordered them here, as you can see, by percentage. And you can see Daimler 2.28% positive on the session at present market pricing. This is far outperforming a lot of the other companies within the index. What happens though is Daimler is the first of the major car makers to report in Germany. If Daimler are performing well, what do you think Volkswagen and the other car makers are probably doing? This is when you get the first company reports for a major sector, acts as a bellwether for sentiment then for the rest of the sector to follow suit, and for markets to then reposition themselves for results more often than not to be likely to follow that pattern. Hence the reason why the banks that are coming out tomorrow from the US are important, because it doesn't matter really about Goldman Sachs and all the rest that come next week, because depending on what those first three are like, that pretty much gives you the best insight as to how the sector is performing. So Daimler's positive. Lo and behold, the top three movers in the DAX this morning: Daimler, Volkswagen, BMW. You know, it's not rocket science, but you've got to have a bit more of a lateral mind to think about how this information then starts impacting market prices. Now, just because Daimler had good results, does that mean the DAX is going to shoot to the moon and back? Probably not. But again, it acts as a safeguard, having that knowledge on when you're strategizing your ideas and execution on the indices in the morning. Another big name that's reported this morning, albeit the movement has been much more smaller, has been Tesco. Tesco reporting their first sales growth in 7 years. Anyone who's been in the market long enough watching FTSE stocks, Tesco has had an absolute nightmare in recent years, but it seems as though their turnaround plan is starting to come to fruition, and they've got their first sales growth in 7 years. So better for the longer term for that particular stock. Okay, let's have a quick run through then of some of the main news headlines that have come out this morning, because there's definitely a few things to get you up to speed on, aside from that equity discussion we just had. One is of Donald Trump. You know, the one thing I do love about Trump is his depth of vocabulary. We are sending an armada, very powerful. We have submarines, very powerful. Far more powerful than the aircraft carrier. You know, you can't make this stuff up when it comes to Donald Trump. But obviously, what's happened here is he's kind of just following through and backing up to quite a strong talk following the Syrian strike. And what this prompted, though, is that the US counterpart, Xi Jinping, who he met, if you remember, at the end of last week, has basically rushed through a phone call to Trump, apparently overnight, suggesting that you know, he needs to take. We are taking steps to counter this North Korean issue. It's all in hand. You know, let's stop talking about sending armadas into those waters. You know, it's just trying to act as a bit of a broker to temper the situation. Is China, of all people. You know, how the tables have turned over the recent decades. So certainly, this fragile sentiment at the moment on the geopolitics, although we've had a bit of a bounce this morning, what you are seeing with the charts is that assets like gold are still remaining elevated. You know, we're off the highs, but we're just off 5-month highs. We're still up at 1276. You know, we haven't fully retraced some of the gains that we've seen in recent days, and that's because investors are still seeking to have a little bit of protection in these safer assets in this current environment at the moment until we get a little bit more clarity on the situation. If you remember, there's other meetings going on between Russia, Syria and Iran that are happening at the end of the week. And so over Easter weekend, probably we're going to get some more commentary, and that's really then the response. You know, how strong is the response from Putin when he has those formal meetings later in the week? That'll be key. One of the other things that I've been looking at in the news this morning, well, let's just quickly have a look at the price, is oil. And if you look at oil on a slightly longer dated, we had the initial trigger obviously being the news of the airstrike. We did reverse that by midday when we came in the day after, but since that point we've continued to move higher. Now there's a lot of different variables at play here, but when you start to total them all together or combine them, they do make quite a compelling case for fundamentally for a long bias in crude oil at the moment. And so just discussing a few of those points. Firstly, you've got Saudi Arabia said likely to back OPEC extending output cuts. So now you're getting the kind of big boy, if you like, of the cartel stepping in and saying, you know what, we're willing to support doing more when this current deal ends in June of this year. You've had the likes of Kuwait and Iraq and some of the other still big but not as important or influential as Saudi Arabia talking up the potential of a cut ongoing. Now Saudi Arabia is starting to step into the fray and the discussions, according to a person familiar with the internal discussion. Not only that, you've had a Reuters exclusive source report last night which said that OPEC figures show oil output cuts are exceeding their pledge. Remember, we were talking about the surprise that we had back in really December, January, because OPEC compliance was about 92, 93%, which is way higher than OPEC have ever achieved. You know, they've got a very bad track record of sticking to their predefined quotas. What's happened now is that OPEC have said the cuts that they've done basically amount to 104% adherence to the supply cut regime. So actually, OPEC are cutting over and above the agreed quota. That 92, 93% compliance is now turned into 104% compliance, with Saudis saying they already want to talk about doing more, with the likes of the third, fourth, fifth biggest countries like Kuwait and Iraq all also saying they want to step up and or step in and cut production further. You know, so there's a bit of steam gathering behind this, and they are still very much so going above and beyond their measures in order to prop the price up by cutting reduction more. The other thing, of course, is the supply side, and that's in regards to the API crude oil inventories we had overnight. And this obviously acts as the front runner, if you like, for the Department of Energy numbers we'll get later this afternoon. But one thing that happened last night was that you had a drawdown of 1.3 million. And granted, that was just shy of estimates. 1.3 million is still the biggest drawdown in crude inventories since December of 2016. So you've got the biggest drawdown of stockpiles since December 2016. You've got Saudi wanting to cut more. You've got the overall group of OPEC cutting more than they should be doing. Then you start to layer on the issue of all the geopolitics and the rising tensions globally. You know, there's quite a strong case here to say that, you know, crude oil being pretty well supported, I'd definitely be more favourable at picking a point technically sound to get long in this market, if you're looking at it from an intraday perspective. And that's kind of been the strategy that we've been issuing in the US session for, well, really for a number of weeks, if not months. We've definitely had that bias. The only time was really when we had that US output focus, which has very much been brushed aside by the impact and this pretty quick escalation of the situation following those airstrikes. Upside, obviously crude psychologically, you got the 54 handle, but then ultimately 55.24 marks the kind of year-to-date high, which would be up on the 3rd of Jan at 55.24 to be on the lookout for. You know, we start getting above there, and then obviously next target, those lows in that cluster of price action that we had kind of April of last year comes in at 56.51, and then $60 target, you know, and so on and so forth. So quite interesting at the moment. You can see now we're in the middle of that range, having broken above that kind of 52 handle as to where we are from where we kind of Q4 of last year. So definitely crude looking quite interesting on the fundamentals, which are all kind of leaning as supportive in that fashion. Obviously, if crude is moving sharply higher, the one thing from a cross-asset class mix that you need to be aware of is that if crude starts punching up kind of $1 plus on the intraday, any selling that you're getting in the equity market, which is more of a capitulation of kind of people, stop orders getting run, people chasing the momentum, it almost becomes self-fulfilling when various technical levels are also breached. The move kind of happens in that low liquidity environment, quickly drops down. But if crude is already up like $1 on the day, then you've got to see that as a bit of a risk to holding any shorts in the market in the equity space for too long. So you want to be pretty proactive with the shorts, I'd say, in that scenario. Still with the equity play, I think the identifying the moment of getting in at the dip, buying the dip mantra is still pretty strong, as we've seen evident, I think, every day of this week. Okay, quick look at some other headlines briefly. China producer price growth eases from an 8-year high as consumer inflation edges up. We've talked about this before, the disparity between producer price index and the CPI measure. But producer price growth moderated from the fastest pace in more than 8 years in March as consumer inflation ticked upward despite the continued impact on food prices from an early bumper crop of fresh vegetables. A couple of banks commenting this morning, and this pretty much sums it up. In Commerce saying that the big gap between CPI and PPI points to the fact there's little pass-through effect from the upstream commodity prices to downstream consumer goods, indicating that we haven't seen a solid recovery as yet. Most of these banks, Capital Economics, Nomura, ANZ, Banking Group in Australia, all suggesting that really these inflation readings are not going to have any direct ramification for Chinese monetary policy, and so net default, they're not really that much in focus. Okay, quick look back at the charts. I can see cable just edging up again. Obviously had some inflation numbers yesterday which on the year-on-year basis were in line, but slightly longer term, let's have a look at the chart once it loads up. So you've got the highs coming in from back on the 6th, so it would have been what, Thursday of last week at 25.27. I guess you're going to have to look kind of more that overnight or late US level just being tested at the moment. At this point, given the way the dollar performed yesterday, I'd probably be more comfortable with looking at a long entry still. Maybe pivot might be quite interesting, but actually I prefer the trade in the euro-dollar pair this morning. Looks technically more sound. And if I look at on a 90-minute chart, looking at the euro this morning, it's been edging up. Some slight dollar weakness, so both pairs have been moving moderately higher. But if you look at R1, that's at 106.64. So R1 kind of pretty much matches to that initial high that we had yesterday afternoon. And then also, if you go back, you've kind of got those other support levels that we had back on Thursday. So, given those two levels there just highlighted, I'd be interested to see that also, as I said, marries up with R1 when it gets to that point, whether or not that's a viable potential short entry there, depending on obviously reassessing the market conditions and the news at that time. If it gets to that point, could be quite interesting to look at. Okay, quick look back at the calendar. A couple things to be aware of from this morning. You do have the earnings data coming out of the UK, so this is average earnings, and claimant count change, unemployment rate. I would say really the unemployment rate you can discount. No one's really bothered about the unemployment rate in the UK because it's in a very healthy situation and has been for a considerable period of time. The thing that probably most people will look at is the average earnings data. Particularly when you start reading about how household incomes are being pressured and squeezed by rising inflation, so on and so forth. These are the numbers in which people will probably more focus on that 9:30 release. Given the pound and its proximity to those late US highs, this could be something to monitor. Later on this afternoon, actually it's fairly quiet in terms of US data. The first thing I would keep an eye on though for any oil traders is you do have the OPEC monthly report. Now normally the OPEC report doesn't really have too much of an impact, but we saw last month it certainly did have an impact. That's because people I think are trying to assess what are exactly the OPEC doing and what is the appetite for them to do more, and so the numbers might be quite telling this to give you a better clue and an insight as to what they might consider going forward. Otherwise, import-export prices from the US. Got a Bank of Canada interest rate decision. That's always very interesting for the CAD currency and the FX traders. They always release a statement alongside that, which adds a high degree of volatility. Department of Energy crude oil inventories. Obviously, we'll recap the APIs and the market positioning ahead of that release to try and get an insight as to how the market might react when that comes out. Elsewhere, finally, speakers. There's two really of note. First being Mark Carney. He's speaking at a fintech conference in London today. There is text to be released and there is a Q&A as well. So I would definitely be keeping a sharp eye on this. Even though it's a fintech conference and he's not headline topic speaking on policy of the economy, given that there is text, given that there's a Q&A, I would definitely be interested to hear what he has to say following the data from yesterday, but also his assessment of the overall economic conditions globally. Then you've got the uber dove of the Fed Reserve, that's Kashkari. He's giving a speech at 3 p.m. this afternoon, and that pretty much concludes then your day. So a couple of peaks of interest, 9:30 for the UK jobs data, and then later you've got the OPEC monthly report at midday, Bank of Canada oil inventory numbers 3:30, and then just keep an eye out for Mark Carney in about half an hour's time. Obviously, as per normal, Trump tweets, commentary from likes of Putin, Russia, China, Iran, all to be monitored as well. And just given the movement that we saw in gold and the yen yesterday, which acted as an excellent kind of pre-indicator of market movement, I would still also be looking at those instruments as well quite closely today. But the calendar overall is a little bit more busy, so we might get a bit more direction from that as well today. Okay guys, going to leave it at that. So enjoy the session, and I will see you in the chat room. Thank you.